Federally funded infrastructure projects continue to drive premium growth for U.S. surety bond writers, with underwriting profits in this construction-oriented line of business exceeding $2 billion for a third consecutive year in 2024. That according to a new AM Best report. We're joined today by two of the authors of that report, Senior Financial Analyst Robert Valenta and Senior Industry Analyst Christopher Graham. Chris, as always, great to see you.
Good morning. Thank you for having me today.
And Chris, is it fair to say that the surety line of business has a pretty good reputation for profits?
Yes, this has been a consistently profitable line of business. We just hit the third straight year, 2024 being the third full year in a row for which we have data, of profits being at least $2 billion. Now, it's easy to look at the growth and think that's driving it. We'll get to that a little bit more on that later. But even when you look at these profit margins as a matter of scale, it's outpaced even workers' comp. We all know workers' comp has been a very profitable line for property and casualty for the last 20 years. Well, as a matter of a measurement of return on revenue, surety has been even better than that for over a decade now. The profit margin as well has been the best for any property casualty line over the last 10 years. So this has been a very reliably profitable line of business. You
did mention premium growth. What's the report stating as far as that goes, and what's driving it?
So the premium growth, premium is essentially doubled over the last 10 years for surety. And a lot of that's been even post-COVID. I'm just using COVID as a timeline, not so much that anything from COVID's driving it. Certainly, the booming economy has driven more construction growth. But you also have the Infrastructure Investment and Jobs Act, and all the projects from that have really played a role. Federally funded construction has grown at a faster pace than even private construction over the last few years. So it's been a double-digit premium growth for each year, 2021 through 2024. It looks to have slowed down a little bit in 2025, but still, it is still growing, and most of that you can point to the federally funded projects.
Robert, are there any looming headwinds that may be on the horizon?
Yes, regarding potential headwinds, given the recent decline in private construction spending, total construction spending is down over the past year. This has been partially offset, as Chris mentioned, by increased public construction spending, which picked up significantly from 2023 to 2025 due to federal infrastructure spending. Part of what's driving the decline in private construction spending is increased construction costs for materials and labor. As a result, surety writers are facing higher claims costs, and contractors face macroeconomic challenges from inflation, skilled labor shortage, and supply chain disruptions, which could potentially lead to delays in getting materials to projects or higher prices. So all this has led to firmer market conditions in the surety market. We're seeing sureties are disciplined with pricing, terms and conditions, and risk selection. However, further cost pressures could lead to higher loss ratios in the surety market, particularly given relatively modest rate increases in recent years.
How would you characterize the current role of private construction spending in the segment?
About 3/4 of total construction spending is in the private sector. So the private sector is a large driver of surety premiums. Surety bonds in the private sector are typically for large commercial projects like hotels, office buildings, manufacturing facilities, or for infrastructure such as power plants or telecommunications. So for 10 plus years, as Chris mentioned, through 2024, we saw a period of rising growth in construction spending. And then in 2025 year to date, construction spending in the private sector is down about 1.9%. So included in this is residential construction, which has slowed for a number of reasons, including lower housing starts and lower home builder sentiment. But we'll continue to watch the level of private construction spending and its impact on the surety market.
Robert, Chris, so glad you could join us today.
Thank you.
Thanks, John.
That was Senior Financial Analyst Robert Valenta and Senior Industry Analyst Christopher Graham. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.